Dear Lord, thank you for this day. Thank you for just allowing us to get together on a beautiful day. Lord, we just always pray that we honor you with the way we live our lives. We hope that somehow you can be glorified through what we're doing. We also pray that we can help our customers and our listeners just to help them understand better about how to buy a home, how to buy new construction. Father, we ask this in Jesus' name. Amen. So, welcome back, everybody, to a Residential Resource Podcast. This is a building basics series. Thank you to everybody for your support, reaching out to us, letting us know that, to keep doing the podcast, but also just some things that we need to talk about. I'm going to mention all of our sponsors, and I'm going to introduce a new sponsor today. But just want to say thank you again to Viz 3D Space, Core Building Products, AgCore Steel, Broadside Marketing and Branding, who is actually what's the word I'm looking for? Producing today's podcast. And then our newest sponsor, Victorian Finance, Zac Daniels. And Zac, great to have you with us. And I'll let Zac tell you about his company here in just a minute. But today, we've just had a lot of people ask us about a few things when it comes to financing new construction. So one is just all the fears in the market, some of the things that happened during COVID. We're in an election year. Rates. So we're just going to touch base on some of that, some specific financing options that we're going to discuss, and then some different types of construction loans. And I want to say hello to Lisa again, and glad you're back with us. And I guess we'll kick it off with Zac. Just tell us a little bit about Victorian Finance and yourself. And
Yeah, so Victorian Finance, we're a residential mortgage company. Victorian Finance has been around for 20 years now. I've been working with them, just celebrated my 1 year anniversary. We have a wide range of loan products, and I myself am the new construction manager in the Southeast and specialize with new construction loans, partnering with builders. And we have the new construction team located locally here in Alabama that service all of the builders and home buyers' needs.
I got you. Now, you guys have a little bit of a unique situation. If you don't mind talking about it, to where you guys actually own a bank or are owned by a bank, so that gives you a little more flexibility than a traditional mortgage company.
Yeah, so the owner of our mortgage company is also an owner of the bank, two separate entities. We do not operate jointly, but we do am able to work together and come up with unique solutions and situations. So with our construction loan, we do offer one-time and two-time closes, which I know we'll get a little deeper into. But with the two-time close, the construction loan portion actually does go to the bank in which the owner of our company has ownership with, and then we get it back from the bank and do the permanent financing. But the bank has been a great ally of ours. We've been able to do all kinds of creative solutions when it comes to purchasing a home with buyers because of the bank's support that they give to us.
Yep. Well, great. Lisa, I'll let you, we'll just jump into fears in the market. I guess maybe about the things that happened during COVID, the horror stories people are hearing out there about price increases and those things. So I'll just let you jump in there.
Well, we asked Zac to come talk with us today because we realized that rates are a situation for a whole lot of people right now. Rates are higher than they have been really since I bought my first home a long, long time ago. So there are still some ways to be creative, and are talking with Zac for some of our own customers. He has some really good options to help. There is still a shortage of homes in our market. There are still people that need homes or want to buy a new home. And eventually the rates are going to come back down. We anticipate, hopefully by the end of the year, that we're going to see some better rates. That's what we read, what we hear, and we're hopeful for that. So, we read a lot and listen to a lot, obviously, about the market. And it is still, there's buyers out there, there's a shortage of homes. Buy it. Find some creative ways to go ahead and buy it when the rates do drop. You can always do refis, but real estate is still a really good investment. So we wanted to come to you today with some information on how can you get the best rates possible right now. And you guys absolutely have some really good creative options for that. So I guess we can just jump into some of that with Zac. I know there's some temporary buy downs, permanent buy downs. When we say that, talk about temporary buy down of your rate, permanent buy down of your rate. But I think it's best to come to the professional with that information for sure.
Yeah, tell us about I guess there's short-term buy downs and then permanent buy downs. Can you just try to touch base on each of those?
Yeah, so to talk first about permanent buy downs, those are when you permanently buy down your interest rate on the term of your loan. You'll do that in the term of purchasing discount points. Those have become a more widely used term recently. Discount points lowers the interest depending on the credit profile, loan amount. The discount points will range. It's not easy to say a rule of thumb on how much a discount point will lower your rate anymore. So it really depends on the loan and credit score and whole entire credit profile of the loan. But discount points are tax deductible, so what you pay into to lower your interest rate can be a tax deduction for you on your income taxes, which is a win. And those are something that buyers or sellers can contribute to and lowering the interest rate for the term of your loan.
So that is for the permanent buy down.
That is correct.
So I want to talk about that for just a little bit for Lake specific, which is typically the market that we're building in. Typically, our buyers here have a significant amount of cash that they're putting into the deal. I know Zac and I talked a little bit about that. I'm going to throw out some numbers. Just say you're building a $700,000 house and, if you're putting $75,000 down or $100,000 down or whatever that might be, you could put a little less down and use some money to permanently buy down your rate. And that money is tax deductible versus putting the whole $100,000, which is not tax deductible. So that was really neat to hear that I think would be beneficial for, I know, a lot of our buyers.
Absolutely, because if you, we'll just use your numbers. If you're wanting to purchase a $700,000 house, you have, say, $100,000 to put down. You'll get a bigger bang for your buck as far as your monthly payment goes if you, say, put $90,000 or $80,000 down and use the rest of your money to then lower the interest rate. That becomes tax deductible. You have a significantly less interest rate that will really affect your monthly payment more so than if you would have put it all down on your house, because you're talking about the difference in $20,000 financed over 30 years or $20,000 potentially lowering your interest rate a point or a point and a half.
Yeah. That was a really neat thing to hear and understand for me that would be a really good tool for our buyers here on Smith Lake.
Yes, and with our construction loans, I know I keep bringing those up, and I know we'll talk more about them.
No, let's go in.
But
Wherever it goes.
with the construction loans that we offer, I mean, typically when you think construction loans, you're going to have to do 20% down. You got to have 6 months reserve in the bank. And as you get higher up in price points, I mean, you may have buyers that have cash, but that's still a significant amount of cash that is going to be not only spent, but also kept in the bank after purchase. Then we're talking about trying to purchase discount points on top of that. It can be a really expensive transaction. With our construction loans, we just require a minimum of the agency guidelines. So say you have a $700,000 purchase, that's below the conforming limit. We can do a 5% down construction loan. Now, you may have more buyers that want to put more down, but they're not required to put that 20% down. They can lower it to 15% down. And then we use 5% to apply towards the rate and lower their interest rate for the permanent buy down, and they are out the same amount of cash as they would have been going somewhere else where they were being required to put 20% down.
On the 30-year fixed finance, if you can get a point and a half lower rate, it far exceeds the amount of cash over the term of the loan that they would have to put
Absolutely.
in the deal. Specifically, I wrote this down when you were talking. In regards to rate, how does it affect my rate? Now, again, I understand it depends on credit score, it depends on price of the house, depends on amount you're putting down. But could you move your rate? Let's just say if today's rate's 7.5% on a 30-year fix, could you move it to 5%? If that's point and a half, could you get the rate to 5 fixed? Is that possible?
Well, it is possible, and I have done it. It really depends on the loan amount, credit score. But a great way, and this is a perfect segue into the other option of a buy down. Another great way that we can get there easily is what's called a temporary buy down. Now, a temporary buy down has to be paid for either by the seller of the transaction or the lender. These are typically only going to be on what you refer to as spec homes and not necessarily the construction loan. So something that you, as the seller, is selling, you can pay for a temporary buy down. And what that does is there are different options. We have a 3-2-1, a 2-1, a 1-1, and a 1-0. So there are all kinds of different options. And what those numbers represent, for example, the 3-2-1 buy down is wherever you've locked your rate. We'll use your example of 7.5. Then the first year of your loan, you've lowered that rate 3%. So you'll be looking at a 4.5% interest rate for the first 12 months of your loan. The next year, it's going to go up 1% to minus 2% of your rate. So you'd be looking at a 5.5.
5.5.
The third year, you would be at a 6.5. And then from years 4 through the term of your loan, you're at your locked in rate of 7.5.
But at any time that can be refinanced.
Absolutely. There is no prepayment penalty associated with that. There's no commitment time frame. So the goal is to buy time in the market and take advantages of a lower rate and give your opportunity a chance to refinance in a less riskier situation than, say, an ARM loan.
Right.
Just making some assumptions. Again, I know it's tough for you to get into specifics because there's so many variables, but on a $750,000 house, what would it cost me, the seller, to get that approximately based? Let's just assume 780 credit score, plenty of cash in the deal. Most of our customers do have a good amount of cash. So what would it cost us, the seller, to buy from a 7.5 to a 3-2-1 buy down? What would the approximately cost?
So the approximate cost is going to be about 3 points, and that's roughly 3% of the loan amount that you'd be looking at purchasing into that. And again, this is just for the temporary buy down and something that the seller offers. Now, if they did want to try to lower their rate permanently, the buyers themselves can buy those discount points to lower their rate. It may take a significant amount of money to go from 7.5 to 5.5, depending on the credit score and loan amount, but that is also something that the sellers can contribute for, so they both can pay into it.
I was going to ask you that. Can you stack it and everybody participate? So they could buy down their permanent, but also buy down their 3-2-1. Can you stack them like that?
You can stack them, and you can also stack the permanents. So, if they want to put 1% towards a permanent buy down and you contribute 1%, they've done 2% into a buy down situation that is a permanent buy down instead of temporary.
Interesting.
But yes, you can stack a permanent buy down with the temporary buy down as well.
Yeah. And I don't want to be redundant, but we're using terms like stack and 3-2-1 and 2-1. And I know you explained the 3-2-1 buy down, but can you just explain the 2-1 buy down and the 1-1 just so that we're clear? You did explain the 3-2-1.
Yes. So, and in regards to a 2-1 buy down, using the same examples as before, if you've locked in at a 7.5% interest rate, the 2-1 buy down will be lowering your interest rate that you're paying for the first 12 months to 5.5%. And then it will go to 6.5% year 2, and year 3 through the term of the loan will be 7.5%.
I got you.
In regards to doing a 1-1 buy down, that is lowering the interest rate 1% for 2 years. So if you're at that 7.5, you would be at a 6.5 years 1 and a 6.5 years 2, and then you would go up to 7.5 years 3 through the term of the loan.
I got you. Well, we don't talk really much about our own company and what we do have, but I can just tell you, like we currently have a house on the market. It's 729.9, a spec home. It's nearing completion. That we as a seller would happily, if it would be the difference of the house sitting there for, either losing money on a different investment because we've got it tied up there, or paying interest payments, that I would rather give that money to a purchaser to help them own that house than I would just to let it sit. So we would definitely participate in a program like that as a builder on that particular home. I would love to do it for somebody. So that was a shameless plug, is what we call that.
Well, no, and it's a great thing to mention.
Well, it's good for any seller right now. Yeah. If a seller can do that for their buyers, that's a really good tool for any seller in this market, to have some creative opportunities to help the buyer go ahead and get in that house that they need.
Absolutely. And, with contributing towards a program like that and being able to refinance out of it later. I'm sorry, I'm going to steal Marty's shameless plug here. And
That's quite right.
If they do financing with Victorian Finance myself, that we will offer a free refinance with up to 5 years after the purchase of the home. And what that free refinance entails is there's no lender fees charged. So there's no origination, processing, underwriting, and we'll actually cover the appraisal fees as well. You'll be still subject to title fees, but typically with any title company, if you close with the same title company, and then it's just a reissue of title, and is much cheaper than having to do a full title search.
I got you. So we talked some different financing options. I'm sure there's literally hundreds more of those depending on your specific situation. But do we get into, or maybe I missed it, but 1-time and 2-time close?
I would like to talk about that, because we've had some customers talk through that with us, the fees of closing 2 times versus 1 time. And you talked to us about that with the way that your financing or your closing fees are.
Yeah, so we do offer both 1-time and 2-time close. My personal opinion, the 2-time close is a little bit better of a situation, especially in a market like we're in today. As far as fees go, yes, you do pay closing costs twice. You would pay closing costs up front at the close of the construction loan, and then there is a permanent takeout financing set up much like a refinance at the end of construction that you'll pay closing costs on. With our bank referral partner, we're able to really minimize those fees so that the fees end up being close to, if not the same, than what you would already be paying in a 1-time close anyways. The perks of the 2-time close is you have a fixed rate on the construction loan. It's interest only through the term of construction. You only pay interest on what is drawn and used during construction. And then at the end of construction, you're open to subject market fees and rates. So in today's environment where we're at, this being an election year, there's all talks of rates potentially going down. Of course, we all know they have not. They've actually been higher this past 3 weeks than they've been since last fall. But the Fed is still supposed to be cutting interest rates. They've made a commitment to do so. Election years are always a very volatile year for interest rates, and projections show that in the year 2025 we could be looking at a completely different market. So in building out a construction loan, being open to the market rate at the end of construction is more beneficial, in my opinion, right now. But like I said, we do also do the one-time close. The difference is you will lock in your interest rate at a premium at the beginning of the construction process. There is a allowed float down rate option tied to that, but again, you've locked at a premium, building out worst case scenario and what the market may hold in the future. So it is going to be a little bit higher than what market rate could be if we wait and the interest rates fall next year.
And I think just to, I guess, echo on that, I know you and I talked about this before we started. If you're doing a build that's a 10-month build cycle, it is most definitely, it should be advantageous for you to do the 2-time close, because odds are, what we read, what we think and hope, rates will go down at the end. So it would be advantageous for you to have that second closing and get a better rate at the end versus locking that in right now.
Yes, and that, again, that's just one man's opinion,
Yeah,
but that is what I believe to be true for today's market.
A couple of terms you used. Well, it's one question I had, and then a term you used. I just wanted you to explain it. But 2-time close and 1-time close. I've seen our customers in the past be misled by that it's more expensive to do a 2-time close, because typically what we found that it's really about the same. They're just kind of burying the cost of the second closing in it. Is it true that it's about the same typically for the 1-time or 2-time close as far as closing costs?
Well, for our company specifically, yes, it is about the same. The bank will have minimum fees. There is an origination fee, and then you have title fees, and that they will cover the appraisal costs themselves. So those are the only fees that you're paying for up front on the construction. And then you get to the closing, you'll also have reduced fees before coming back to us, because how we'll set the process up is we pre-qualify the buyer and refer them to the bank. They come back to us, the fees are reduced on our end, and all in all, it ends up washing out to be very close to what the 1-time close fees would be.
Yeah, I would just caution our listeners just to be sure that you dig into that, because a lot of times it's a 1-time close, but just hearing you talk, that's actually a little bit higher rate, and the fees are actually pretty much the same. So just to be sure that you're clear on what your fees are, and that it's not actually less expensive to do the 2-time close, because of the 0.5% lower rate and equal closing, then it's definitely cost you, especially long term, it's costing you less money. And then a term you used that I understand, but the float down, is there a float down option? And can you explain what that even means, a float down?
Yeah, so, and talking with the 1-time close, and usually this term comes up a lot with extended locks, which means you lock in your interest rate today for a long period of time. So in terms of the 1-time close construction loan, you're locking in your rate through the end of construction. And what the float down does is it monitors the market, and if there is a price improvement in your interest rate, then you are allowed to float your interest rate down to what the market is. So it is a bit of reassurance, especially in a volatile market, that if you go ahead and lock today, if rates come down, we will reduce your interest rate before closing. The float down option is good through the construction period of the 1-time close.
I got you. I will just say this, like we talk about a lot, I'm sure we'll talk about some more, but if whether you're building with us or you're financing with you, if you are that was a lot, and it could be very intimidating. So if you're unsure, I'm sure you would be glad to talk.
Absolutely.
But definitely, we as well, residential resource, we want to be truly a resource for people who are building a house, buying a house, financing a house. If you just have questions, we were happy to take your phone calls. Again, you don't have to be doing business with our company. We just want to be here for our listeners. Just if you just have a simple question about, hey, I'm thinking about this, but I'm overwhelmed, because I think I've heard that term a lot, especially in this environment, that people just want to get it right. I would just ask, is there anything that we really haven't covered in regards to financing new constructions or buy downs or rates or programs, of anything that you can think of that you'd like to touch base on?
No, I mean, I know we just threw a lot at one time there. I feel like we did cover at least most of the high points. We covered the two different types of construction lending. We covered market conditions. We covered buy downs, temporary buy downs, permanent buy downs. So, that.
Go ahead, Lisa.
Well, I think it's with your lender, it's the same thing that we said in the first podcast about getting to know your builder, talking through your goals and how can your builder help you meet your goals. I think your lender is the same way. Find someone you can trust and say, here's where I am. You can assess their credit score, the income, how much cash they have down, and what their goals are for their monthly payment. I think that get someone that you can trust to get all that information to, and, just say, help me with all this that you've talked about. And then some, what's the best option for me to reach my goal for our family? I think that's a great place to start. And you can give us a call, or I know that we'll have Zach's information on the screen during the podcast also, so that they can give you a call. But I think it's just finding someone you can trust to give all that information to, and then be advised how can they reach their goals for their family.
That is exactly right. And that's what it's all about. I mean, having a consultation with a potential buyer, having the goals. What do you want your monthly payment to be? What do you want your cash out of pocket at close to be? Is equity more important to you up front? Your down payment? Is your monthly payment? I mean, figuring out what everyone's goals are, and being able to structure the mortgage loan to meet their needs.
We have, I don't mean to jump in on you, Marty. We have one of our project manager, Mary, is looking to be a first-time home buyer. And I gave her Zach's phone number. And again, first-time home buyers have different goals. And this is the first time they've done that. And I know you've been wonderful with explaining things to Mary, looking for options that are out there right now for first-time home buyers, and giving her, okay, and you even copied me on the email as her realtor. Here's a couple of different options. And you've just been really informative with her and also with me, so that I can help guide her as well as much as I possibly can in the house.
Absolutely.
Search.
Goals are important, and exploring different loan programs are important. We have a wide variety. There's conventional FHA, VA loans, USDA loans, and other down payment assistance and bond program loans as well. So we can explore all kinds of different options and find what is really best for the client.
Absolutely.
Couple of notes. I guess it's important to people, because people are holding on. It's an election year. People tend to want to hold on to more of their cash. And I think you touched on it, but I just want to see if you would just reiterate about cash, because normally banks want 20, even 30%. And I think I heard you say you do have some options where there's a lot less cash out of pocket required. So can you just run over that one more time?
Yeah, so with our construction loans, we have just the agency max requirements for loan to value. And what loan to value is the loan amount per the appraised value of the house, or the purchase price, whichever is lesser. And so with conventional conforming rates, if you are not a first-time home buyer, the minimum you can put down is 5%. So we can do a construction loan with as little as 5% down on a conventional loan. Now, FHA loans, there's county loan limit requirements, but they will just require as little as 3.5% down. You do not have to be a first-time home buyer to put 3.5% down with FHA. So we can do a construction loan, an FHA construction loan, with 3.5% down. VA, it depends on your disability entitlement that you're issued from VA as a veteran. You could be eligible for 100% financing, zero money down. We can do a construction loan with VA for zero money down if all entitlements are there.
I got you. Another, just something I want to mention. We were just talking about fears in the market in the very beginning, but there's a lot of people, some of our customers included, that during COVID the prices doubled in a lot of cases, and so there's just this buzz in the market about the fear of my costs going up. I guess in this environment, costs are flat or even decreasing. So where we as a builder during COVID would not dare, we just couldn't afford to sign a turnkey contract or a fixed price contract. Where in this environment, we do them every day because the costs are typically flat or decreasing. So I just want to kind of bring up that fear because it's out there and it really happened to a lot of people in very recent history. So we even get people calling in now. It's like, I want a fixed price. I don't want a cost plus contract. Rates, again, just they keep saying they're going down, but they're remaining relatively flat. But I do feel like they say that Washington has no effect on the interest rates, but mysteriously they typically get better right before an election. So I'll just leave that as it is. But that rates most likely going towards an election will decrease. But your programs give you the ability to have that good rate now. Mm-hmm. And then if they float down, you have a no charge refi so that we can lock in for the full term.
Absolutely. And so that goes back to really what everyone's goals for cash out of pocket is and requirements on the construction loan. There's a lot more flexibility when the minimum to put down is 5% as opposed to 20%. Even if you're wanting to put more than 5% down on your loan, you can put 15%, 18%, and then still use that cash that you would have had to put down to get to your 20% to lower your interest rate. You've come out of pocket the same amount of money as you would, but you have a lower interest rate and, paid towards a tax deductible cost.
Mm-hmm. Yep.
I love that.
Definitely. Long term, it's, if you're 0.5% lower and it's $10,000, $15,000, even $20,000, if you're going to keep the house for 7 years, you're better off to spend that cash to buy your rate down than to put it down on the house.
Absolutely.
So I'm obviously,
and with tax deductions. So
yeah, you can help with that decision, obviously, just running scenarios. So that, for me, do you have anything else we need to talk about? There's some fear out there in the market about, should I go now? Should I not go now? And we just wanted to try to help eliminate some of those fears. I'll just say it's Zac Daniel, and it's zdaniel@victorianfinance.com. Yep. Do you want me to give your personal cell phone number out on the air?
Yeah, my personal cell phone's everywhere.
Okay, just making sure before I didn't give that. That's 256-506-8355, correct?
Correct.
Again, it's zdaniel@victorianfinance.com, 256-506-8355. So,
and if I could, you could also go to my website, complete loan applications, read reviews. My website is Zac Daniel, that's ZAC Daniel, DANIEL .victorianfinance.com.
And we'll maybe roll that on
we'll
the
put that on the
podcast.
screen.
We'll see if Taylor can help us with that.
So, are you mic'd up today?
I'm not.
Well, I was going to get you to do a shameless plug as well. But again, thank you to Victorian Finance for sponsoring this. I'm going to just hit our sponsors again. Viz 3D Space, Core Building Products, AgCore Steel, Broadside Marketing and Branding. And again, Victorian Finance, thank you all for sponsoring this. And we'll see you again soon.
All right. Thank you.
Thanks.